Welcome. Since the release of the last quarterly data, we have seen the oil price climb to near $100 US a barrel. Are there other upside risks to tomorrow's inflation rate?
Well, because the ABS now produce a monthly CPI, we effectively have 2 months out of the quarter. And so there's less risk of a really significant surprise. But there are some areas of uncertainty. So we know that utilities prices have increased quite significantly, in particular electricity prices. But the challenge there is there are a lot of rebates which some households get, some households don't get. And so exactly how they all aggregate up together leaves a bit of uncertainty on that. But we're looking at a relatively strong number.
How long is the RBA prepared to observe a volatile oil price before raising rates, given that some economists have been arguing that in the long term it is in fact a deflationary force?
Ordinarily, the RBA would like to be looking through shocks to oil prices. They consider that a supply shock, and so long as that's not going to be affecting inflation expectations and ongoing inflation, then they would ordinarily look through that. The risk is that at the moment, as we saw with the previous board statement, the board said that they have a low tolerance for inflation returning to target more slowly than they had forecast. And so I think if we have that pickup in oil prices adding to petrol inflation, adding to inflation, the risk is that that increases inflation expectations, wage demands, and makes inflation a bit more persistent. So I think they've got less tolerance than usual.
The RBA's published expectations are of a 0.9% rise on the trimmed mean measure in the September quarter. You said you're expecting a strong figure. What do you expect inflation will come in at tomorrow?
Well, so the RBA published those forecasts before we'd seen the increase in oil prices. So there's a little bit more on top of their number. So I'm sure they're expecting by now something a bit stronger than 0.9. I think we're likely to see something around the 1% or 1.1% in the quarter. If it's much stronger than that, then I think that's trouble.
What do you expect we'll see in a fortnight when the board meets?
Well, so at the moment, financial markets think there's about a 25% chance that they will increase. That's likely to get revised a lot, depending on what the CPI number is. If we see something stronger than sort of 1.2%, I expect that a lot of people will think that the Reserve Bank will increase rates for that reason, that they have that low tolerance.
How finely balanced, though, is this for the RBA, given what we know about consumer sentiment and spending right now, the softening around the edges of the labour market too?
Yeah. Well, the Reserve Bank needs to engineer a slowdown in economic activity in order to bring inflation back down to target. The question is how slow and how quickly that progresses. We are seeing a slowdown in the labour market, but probably at a slower rate than we might have expected. And then there are some areas where the economy is looking more resilient. So, the housing market is up, which will add to consumption as well.
Would the housing recovery prompt the RBA to move rates higher?
So not in and of itself. So the Reserve Bank certainly doesn't target housing prices, but what they would be mindful of is the impact that the housing market has on consumption. So when housing prices go up, people feel wealthier, they can spend more.
And for those considering whether to punt on the races or the potential for a rate rise in November, is there any reason, Jonathan, to believe that the RBA would be more likely to move in November than December if a rate rise is indeed in the offing?
Yeah. Well, so, the one thing is that 4 times a year the Reserve Bank produces its statement on monetary policy, which is its long explanation of, what's going on in the economy, and that's when it revises its forecasts and produces new forecasts. So one of those times is November. So historically, we have seen that the Reserve Bank is sometimes a bit more likely to move when they revise those forecasts, because that's their chance to take a fresh look at the economy and reassess what the path of inflation, in this case, the hopeful path back to target, will be. So at the margin, maybe they're a little bit more likely because of that revision of forecasts, but it's very much going to be data dependent. And, I think the key, given that we didn't get a strong signal out of the labour market data recently, the key is going to be the inflation data.
Jonathan Kearns, thank you.
Thank you.